Right now, somewhere in the global financial system, a clock is ticking. Not a metaphorical clock, a real one. And the last 3 times this clock ran out, millions of people lost everything. Their savings, their homes, their jobs. And it didn't happen slowly, it happened in a matter of weeks. The mechanism behind it has a name. Economists call it the Minsky Moment. And once you understand what it is, you will never look at the financial news the same way again. Because the signs are everywhere right now, and almost nobody is talking about it. Let me take you back to 1998. A hedge fund called Long-Term Capital Management was considered the smartest money in the world. It was run by 2 Nobel Prize winners in economics. It had former Federal Reserve officials on its board. Its models were supposedly flawless. For 4 straight years, it had returned over 40% annually to its investors. Wall Street believed it was untouchable. And then in the span of about 4 months, it lost $4.6 billion and nearly collapsed the entire global financial system. The Federal Reserve had to organize an emergency bailout because if LTCM went down, it would have taken dozens of major banks with it. The contagion would have been unstoppable. What happened? The Minsky Moment happened. Hyman Minsky was an economist who spent most of his career being ignored. He worked at a small university in St. He didn't have the fame of Milton Friedman or the platform of Paul Krugman. He wrote dense academic papers that most of Wall Street never read. But he understood something about human nature and financial systems that almost everyone else missed. His core insight was this: stability is destabilizing. Think about that for a second because it sounds like a paradox. How can stability be destabilizing? Here is how it works. When times are good and markets are rising and economies are growing, people start to feel safe. And when people feel safe, they take on more risk. They borrow more money. They make bigger bets. They stop worrying about what could go wrong because nothing has gone wrong in a long time. Investors stop stress testing their portfolios. Banks lower their lending standards. Corporations load up on debt because the cost of that debt is low and the returns look guaranteed. Minsky identified 3 stages of borrowing behavior that every credit cycle goes through. In the first stage, borrowers take out loans they can repay from their income. The loan payment and the interest, all covered by what they earn. This is conservative. This is healthy. This is where every cycle begins. In the second stage, something shifts. Borrowers start taking out loans where their income only covers the interest. They can no longer repay the principal from earnings. They're counting on the value of the asset they bought to rise so they can sell it later and pay off the loan. This is where you start to see cracks forming, though nobody notices yet because asset prices are still going up. In the third stage, it gets truly dangerous. Borrowers are now taking out loans where their income doesn't even cover the interest. They are counting entirely on asset prices to keep rising just to stay solvent. They need to keep borrowing more money to pay off the old money they borrowed. Minsky called these borrowers Ponzi borrowers, not because they were running a scam, but because the structure of their debt was mathematically identical to a Ponzi scheme. It only works as long as new money keeps coming in. And here is the brutal truth about the third stage. By the time the entire system is full of Ponzi borrowers, the crash is no longer a possibility. It is a mathematical certainty. The only question is what lights the fuse. In 1998, the fuse was Russia defaulting on its government debt. A sovereign nation said we cannot pay. That single event rippled through the global financial system and exposed every over-leveraged position everywhere. LTCM's models had not accounted for the possibility that assets which had never moved together would suddenly all move in the same direction at the same time. When panic hits, correlation goes to 1. Everything falls together. The Federal Reserve cut interest rates 3 times in 7 weeks. The bailout was organized in secret over a single weekend. And the crisis was contained. Barely. But here is what nobody talks about. Containing that crisis didn't solve the underlying problem. It delayed it, and it made the next one worse. Because when the Fed stepped in and rescued the system in 1998, it sent a message to every investor, every bank, every hedge fund on the planet. The message was, take risks. If it gets bad enough, we will save you. That message had a name too, moral hazard, and it planted the seeds for what came next. And the seeds grew fast. Between 1998 and 2007, American households doubled their total debt. Wall Street invented entirely new financial instruments designed specifically to move risk off bank balance sheets and into the broader market, where it would be someone else's problem. The derivatives market, which is essentially a market for bets on top of bets, grew from about $72 trillion in 1998 to over $500 trillion by 2007. That number is not a typo. $500 trillion in financial contracts layered on top of a global economy that was producing about $60 trillion in real goods and services per year. The entire system had become a pyramid of paper resting on a foundation of borrowed confidence. Nobody rang a bell. Nobody sent out a warning. In fact, the opposite happened. In 2004, the Federal Reserve Chairman at the time gave a speech where he described the era as the Great Moderation. He argued that better monetary policy and better financial innovation had permanently reduced the volatility of the economic cycle. The world's most powerful central banker stood in front of a room full of economists and told them that the system had learned how to manage risk. Minsky, had he still been alive, would have recognized that speech as the most dangerous kind of signal possible. The declaration that this time is different is always made at the top. Fast forward to 2008. By that point, the entire American housing market had become a system of Ponzi borrowers. Millions of homeowners had mortgages they could only afford if house prices kept rising. Banks had issued trillions of dollars in loans to people who could not afford them, then packaged those loans into financial products so complex that even the people selling them didn't fully understand what they contained. Rating agencies had stamped those products with AAA ratings, the highest possible seal of safety, because their models were built on historical data from a time when the housing market had never fallen nationally. The fuse this time was a small statistical uptick in mortgage delinquencies in late 2006. That's it. That was all it took. Because the system was so leveraged, so interconnected, so dependent on asset prices continuing to rise, that one small crack spread everywhere at once. By September 2008, the global financial system was days away from a complete freeze. ATMs might have stopped working. Payroll systems might have failed. The supply chains that stock grocery stores might have broken down. The stock market ultimately fell about 57% from peak to trough. About 8.7 million Americans lost their jobs. About 10 million lost their homes. And that was with the largest government intervention in financial history. Trillions of dollars injected into the system. Interest rates cut to essentially zero. Banks nationalized. Assets purchased directly by the Federal Reserve. Now here is the part where this stops being history and starts being current events. After 2008, the global financial system was rescued with debt. Governments borrowed massively to stimulate their economies. Central banks created trillions of dollars, euros, and yen out of nothing, and used that money to buy financial assets. Interest rates were held near zero for over a decade in the United States. For years, they went negative in Europe and Japan, meaning you actually had to pay the bank to hold your money. What does near zero interest rates do to human behavior? It does exactly what Minsky predicted. It pushes everyone up the risk curve. When safe assets return nothing, investors chase yield in riskier assets. Companies borrow massively because the cost of debt is almost free. Private equity firms buy everything they can, loading companies up with debt because the math works when rates are low. Governments borrow because the interest payments are manageable when rates are near zero. For over a decade, the world went on a debt binge, unlike anything in modern history. Global debt went from roughly $170 trillion in 2008 to over $300 trillion by 2023. That is not a rounding error. That is a system that has borrowed its way through every single crisis and bet that rates would stay low forever. And then inflation came back. In 2022, central banks around the world had to do something they had not seriously done in 40 years. They had to raise interest rates aggressively to kill inflation. The Federal Reserve raised rates faster than at any point since the 1980s. And what happens when you raise rates in a world that has spent 15 years building financial structures that only work at near zero rates? The Minsky clock starts ticking again. Companies that borrowed at 2% and need to refinance at 7% are suddenly in serious trouble. Commercial real estate, which was valued based on cheap debt, is now facing a reckoning as those loans come due. Regional banks in the United States are sitting on massive losses in their bond portfolios because bonds fall in value when rates rise. In early 2023, Silicon Valley Bank collapsed in 48 hours. It was the second largest bank failure in American history. Two more banks followed within weeks. And once again, the government stepped in. The Federal Reserve created an emergency lending program to prevent further bank runs. The crisis was contained, barely, again, but the commercial real estate problem did not go away. It got quietly worse. Office buildings across America are sitting at 30, 40, sometimes 50% vacancy because remote work permanently changed how companies use space. Those buildings were financed with debt. That debt is coming due. The loans need to be refinanced at interest rates 3 or 4 times higher than when they were originally written. The math does not work. Hundreds of billions of dollars in commercial real estate loans are expected to mature between 2024 and 2026, and a significant portion of them cannot be refinanced at current rates without the borrower taking a catastrophic loss. The banks holding those loans know it. They are quietly extending terms, pretending the problem will resolve itself, hoping rates come down before the reckoning arrives. This is called extend and pretend. It is what banks do when they are in Minsky's third stage and they know it. Meanwhile, the United States government is now spending more on interest payments on its national debt than it spends on national defense. Not total debt service, just the interest. The federal debt has crossed $34 trillion and is growing by roughly $1 trillion every 100 days. At current rates, interest payments will consume an ever larger share of the federal budget every single year going forward, crowding out spending on everything else. This is not a political opinion. It is arithmetic. And it is exactly the dynamic Minsky described when he talked about borrowers who can no longer service their debt from income and are simply rolling it forward, hoping conditions improve. Here is what Minsky would say if he were alive today. Every time you contain a crisis without resolving the underlying debt, you are not solving the problem. You are deferring it. And every deferral requires more intervention next time. The system becomes more fragile with each rescue, not less. The Ponzi structure gets bigger. The question is not whether another Minsky moment is coming. According to the framework Minsky built over his lifetime of work, it is inevitable. The question is what lights the fuse this time, and how big the system has grown since the last time anyone let it truly reset. In 1998, the crisis was contained to one hedge fund and the contagion of a single sovereign default. In 2008, it spread to the entire American housing market and threatened the global banking system. Each crisis has been larger than the last. Each rescue has required more money, more intervention, more debt. The total debt in the global system right now is larger than at any point in human history. The interconnections between financial institutions are deeper, the derivatives markets are more complex, and the political will to let any large institution actually fail has never been weaker. There is something else worth understanding about how Minsky moments actually unfold in practice, because it is never the way people expect. The popular image of a financial crisis is a sudden shock, a single dramatic event that everyone sees at once. Black Monday, Lehman Brothers. But that is not really how it works. What Minsky described was a slow, invisible deterioration, followed by a sudden, violent recognition. The deterioration happens over years. The recognition happens over days, and by the time everyone recognizes what is happening, the damage is already done. The people who understood what was coming could not stop it. They could only get out of the way. The signs are not hidden when you know what to look for. Credit spreads start to widen, meaning the gap between safe and risky borrowing costs begins to grow. Liquidity quietly dries up in corners of the market that most people never watch. Investors start to notice that selling certain assets is harder than it used to be. Volatility in normally calm markets begins to spike without an obvious reason. These are the tremors before the earthquake. They show up in the data weeks or months before the crisis becomes visible on the front page of a newspaper. Minsky spent his entire career trying to build a framework that policymakers could use to read those tremors, not to prevent the cycle, which he believed was impossible given human nature, but to manage it, to intervene earlier, to reduce leverage before it became catastrophic, to accept small corrections instead of allowing the system to build toward a collapse large enough to threaten everything. When Hyman Minsky was writing his papers in the 1970s and 1980s, his colleagues thought he was too pessimistic, too focused on instability, too unwilling to believe that regulators and central banks had learned enough from history to prevent another collapse. He died in 1996, 2 years before his most famous prediction came true for the first time. He never got to see how right he was. He never got to see 2008. He never got to see a global debt load of $300 trillion built on the foundation of a 15-year experiment in zero interest rates. But his framework is still here, and it is still ticking. The next time you hear that markets are calm, that volatility is low, that investors are confident, that growth is stable, remember what Minsky spent his life trying to tell us. Stability is destabilizing. The longer the calm lasts, the larger the bets become. The larger the bets become, the more catastrophic the moment when they unwind. That moment has a name, and history has shown us, more than once, exactly what it looks like when it arrives.